Hi guys, welcome back to Father and Son Investing. This is just a mid-month update for Treasury notes and bonds. I'll talk about bills in a separate video because different things are happening. Let's just talk about Treasury notes and bonds. I'm going to give you 3 reasons why you should be expecting rates to go higher. So let's get started. All right, reason number 1 has to do with the new 2025 federal budget proposal from the White House. And what we'll see in that proposal is that in order to make a budget, they have to decide what they think interest rates will be. So the projections for the interest rates for 2024, when it comes to the 10-year Treasury note, that has gone up. Last year, they expected 2024 it would be 3.6%. That has now gone up to an average, they're saying average again, of 4.4%. Well, let's just take a quick peek at what the 10-year Treasury note yield looks like right now. This is what the 10-year Treasury note curve looks like year to date, and we'll see that as of the most recent date, 4.318%. Of course, that went up after the inflation data came out. So right now we're less than what the White House is expecting as an average for the year. If we look back earlier in the year, we're going to see that it was significantly less than 4%. To me, then, if the White House expects an average of 4.4%, that means that we could expect to see rates rising above 4.4% in order to get it to that average for the year of 4.4%. So that's reason number 1 why I expect rates on Treasury notes and bonds to go up. Let's talk about reason number 2. Here is reason number 2. I talked about this during the initial video for March of 2024 when it came to U.S. Treasuries. Here's a follow-up on this topic. Again, look at this. Last time I talked about the 5-year Treasury note and what a dud it was when it came to its auction. And here's the headline from MarketWatch for the 10-year Treasury note. Treasury's $39 billion auction of 10-year Treasury note goes badly. What happened? I've explained this before, but essentially there's kind of a pre-market that goes on before the auction where all of these people who will be buying Treasury notes or bonds sort of decide what they think the price will be before the auction. And then when the auction result actually comes out, they can compare what they thought the price would be ahead of a time or what the yield would be ahead of time compare that to the results. And in this case, the auction tailed by 1.1 basis points as a sign that demand for notes was low, meaning the government had to add some extra into what people thought the yield would be in order to get people to actually buy these Treasury notes. Again, some other data in here, we can see that the indirect bidders, think of that as foreign purchasers, 64.3%, that was below average, and the dealers had to step in and take more than what they usually do, 17.1%. So this gives us an idea that folks are getting a little bit worried about the U.S. government debt and demanding a little bit more from the Treasury Department in order to purchase this debt. So we're going to keep an eye on these Treasury auctions again to see how they go. Now, I'll tell you that the 30-year Treasury auction was reported as going pretty good recently. So we're seeing a little bit of some bad auctions and still some good auctions. So we're going to watch to see whether these Treasury auctions continue to go badly here. But this is reason number 2 why I expect these note and bond interest rates to start going up. And reason number 3 has to do with the strength of the economy and with inflation. So let's just take a peek at some comments from Janet Yellen. This is what she had to say back in January. There are people who feel quite strongly that nothing fundamentally has changed and yields will eventually settle back. But then she went on to say, but the strength of the economy also suggests that perhaps productivity growth and potential output growth have increased and the level of yields would be higher. Essentially, she's saying that we're not really expecting yields and interest rates to go back to pre-pandemic levels anytime soon. And also, as a part of this 3rd reason having to do with the strength of the economy, I'm going to borrow a chart here from wolfstreet.com. Looking at the recent PPI numbers, of course, CPI and PPI came out this week, and looking at core goods, finished core goods PPIs. So this one strips out the cost of energy when it comes to these core goods. But this line here in blue, look at how we're seeing things ticking up, and when we look at here in red, this is the 3-month average annualized. Again, things are starting to churn back up. This looks like inflation is not going down anytime soon and potentially could be going up. Of course, if inflation is going up, we could expect the Fed to keep those interest rates up higher. Hopefully they wouldn't be raising interest rates even higher, but they may have to if inflation keeps turning upwards. So there it is, 3 reasons why I expect Treasury yields to be going up, and therefore why I am reluctant to go all in on Treasury purchases right now. However, if you are a person who is looking at these current rates and thinking I would be really sad if I didn't buy at 4.318%, then certainly you might want to consider go ahead and buying some. But as for me, if I buy some, I would also be holding back some of that money to purchase at an even better yield, which is what I'm expecting. So there it is, the mid-month update for U.S. Treasuries. Things have changed quite a bit since the start of the month. Hope this information was helpful for you. If it was, please give us a thumbs up. And if you thought it wasn't, give us a thumbs up anyway. Until next time, enjoy your investing.